afternoon, everybody, and welcome to the Option Pit Guest Webinar Series. And I want to thank you guys for coming. My good friend Steve Bigalow is here. Steve Bigalow is the master of candlesticks. All right, when I dry my kid off and I say rub-a-dub-dub, 3 men in a tub, the butcher, the baker, and then what I say is, and Steve Bigalow. That is what I do. That's how good at candlesticks he is. With that, I want to introduce my friend and just really trading expert, Steve Bigalow. He's going to bring us a really cool indicator and trading technique that he's developed. So with that, I will hand it off to Steve Bigalow. Thanks for being here, Steve.
Okay, thank you, and thank you for the invite tonight. We're trying to get some spring weather up here in Pittsburgh. It's sunny, but it's still a little bit nippy outside. So the first thing, just to make sure everything is working all right, I usually ask people whether they've seen the presentations before. That way I know how fast or slow to go. So if it was yes, Y for yes, N for no. Oh, and a question mark. Okay. All right. So it looks about 50-50. All right. Okay. What I'm going to do then, I'll try to go back and kind of show what the signals are. But the reason we call this the unfair advantage is candlestick signals. I started by accident using candlestick signals, or somebody introduced them to me well over 30 years ago. I used to be a stockbroker. I got out of the business because I realized that the brokerage firms had no more ideas about what made prices or the markets go up or down than anybody else. So I got out of the business, and then when I was buying houses in Atlanta, Georgia, renovating and reselling them, somebody dropped candlesticks on my desk, and I figured anything as sophisticated sounding as candlesticks wasn't worth the time and effort. But they kept hounding me, and I finally picked up the information, and as I was looking at the information, I said, man, this all makes sense. And the more I kept looking at it, the more sense it would make. So, and I tell people back then, I was trading commodities, and I didn't do it with any format. I just bought and sold things without any plan. And so when candlesticks came along, they just seemed like these are good common sense setups or reasons for looking at the charts. So unfortunately, when I was learning candlesticks, there was nobody around to talk candlesticks with. Usually it's pretty good to get a second opinion while you were learning something, just to see if you're on the right track. And unfortunately, I tell people back then, the only time I could get a second opinion is when I would go to the doctor. I'd say, what's wrong with me? And he said, you're fat. I said, well, I think I want a second opinion. He goes, all right, you're ugly too. So what I did was I learned every single signal, but what I discovered was that there was only 12 signals that you needed to learn out of the 50 or 60 in the candlestick universe, and we call these the 12 major signals. And what are the signals? The Japanese race traders basically took what we know as the bar chart, and they would close in. If it opened here and closed above where it opened, it created a white candle or a bullish candle. If it opened here and closed here, it created a dark candle. And that didn't necessarily mean a price was up or down on the day. It just told you what happened after the open. So the thing that kept me going with candlestick signals was that it is basically the accumulative knowledge of everybody buying and selling during a specific time frame. And the nice thing about candlestick signals is that it works on the 1 minute chart, the 3 minute chart, the 10-minute chart, just as well as it works on the daily, weekly, or monthly chart. It's still the accumulative knowledge of everybody buying and selling during that time frame. So here's the 12 major signals, and I guess this is being recorded, so and these are all, we've got lots of trainings on each one. But here's what we did based upon the signals. A lot of people would ask me, what are the best signals? Well, essentially, I've narrowed it down to 6 longs and 6 shorts, but people still wanted them quantified from there. I would tell people the signals don't really, one work better than the other. It all depends on what the market conditions are, whether we're bottoming out and seeing hammer signals at the bottom or dogeys at the bottom. But through the years, what I've discovered is if you put some extra confirming indicators, people often ask, what's your correct trade ratio? And I suspect it's around 70%. Now that doesn't mean that everything is huge, big moves. Some of them are 0.3%. Some of them are 300%. But essentially, I always thought if you could have winners of 70%, you'd make big money. But what else can you expect when you have 70% winners? You can also expect you've got 30% losers. Now, in Japanese candlesticks, it's all based upon common sense of when to be buying and selling. And so the stop loss process is extremely easy with candlesticks. But the other element of it is if you have a signal that's not working, through the years I've heard people tell you, you cut your losses short and let your profits run. The problem is, in the 40 years I've been investing, I've never heard a single person tell you how you cut your losses short and let your profits run. It's very simple when you're using candlestick signals. So one of the major elements of investing is knowing when to get out of a trade that's not working or when to take profits. The other element is if we can find factors for finding better trades and we can knock our loser percentage down to 28.2% or basically improve our correct trade ratio, that becomes an astronomical return over the long time, because for every time you can increase your probabilities of being in a good trade, you lower your probabilities of being in a losing trade. So again, they're very simple and effective stop-loss procedures, but there are signals and patterns that we can quantify that are usually very strong indicators. So, for example, we use candlestick signals with the T-line, and the T-line is very simple. That's the 8 exponential moving average. So we can see buy signals when we use the T-line, and I'll get to that in a minute. We can also see when it's time to come back out of that trade when it's not working, when it closes back below the T-line. The T-line is basically the 8 exponential moving average. Now, what I tell people is this works very simply. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. That combination. You're going to see times when it closes below the T-line, but there wasn't a sell signal. There's other times you're going to see a sell signal, but it doesn't close below the T-line. I used to make very good money just trading off the candlestick signals. And when somebody introduced the T-line to me, one of my private training students years ago, and we put it on the charts, and this is another nice thing about candlestick analysis. We know that the signals work. If they didn't work, they wouldn't be around for 400 years. And all this is basically is the Japanese rice traders putting into graphic depiction what usually goes on in human nature. So the patterns that we're watching are basically the same patterns that happen in human nature time after time. All we're doing is graphically taking advantage of it. So the signals themselves are the graphic depiction of what's going on in human nature. The T-line, unlike the other moving averages that we'll have on our charts, as the red line is the 200-day simple moving average, the blue line is the 50-day simple moving average, and the gray line is the 20-day simple moving average. The reason they're on the charts is that every major money manager around the world uses those to make their decisions about their portfolios. The advantage candlesticks have is that we can see graphically at those levels exactly what investor sentiment is doing. Some signals are stronger to provide a higher profit potential. That's what we're getting into right now, Michael, is how to quantify some of them. So basically, the T-line is a natural number. The other moving averages, they act like magnets because everybody's watching them. Nobody, or a very minute percentage of the people in the world investing use the T-line. So it doesn't act like a magnet. So when it works so effectively, it's basically like a Fibonacci number where it's a natural support and resistance level of human nature. So if you take a natural support and resistance level of human nature and the graphic depiction of what's going on in human nature, now you've got an extremely high probability program that keeps you in the trades and out of the trades at the appropriate time. So just as the uptrend, if you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close above the T-line. Now part of this is, also on here we have stochastics. I use stochastics at 1233, slow stochastics. And very simply stated, if you see a candlestick reversal signal in the oversold area, more than likely you're going to have a bullish reversal. If you see a candlestick sell signal in the overbought condition, more than likely you're in a downtrend. These trends are around, and it doesn't necessarily, this trend doesn't necessarily need to be on a daily chart or a monthly chart. This could be on a 1-minute chart. I used to trade very successfully the E-minis off the 1-minute, 3-minute, 10-minute chart combination. So the signals at the T-line become a very significant factor. Notice, and this is what we can call convergence analysis. The more pieces of evidence that we can put in, there's been a change of investor sentiment, the higher the probability you're going to be in the correct trade at the correct time. So these are bullish haramis. They're in Western terminology, those are inside days, where they open at or above the previous day's close and close below the previous day's open. And the reason they're called harami is in Japanese, that means pregnant woman. There's her body and there's her little belly sticking out. And it essentially tells you the selling has stopped. Now, if you can add that to the fact that we're in the oversold condition and we can see they're doing a smack dab on the 200-day moving average, and then we see a bullish signal. This is what we call a doji sandwich. This is one of the very strong reversal signals. A doji sandwich is a bullish day, then a doji. And there's a very simple rule of the doji, which is they're usually going to move it in the direction of how they open it after a doji. So the next day, if they open it and start trading positive, we can pretty much estimate that this candle right here is going to be the same magnitude as this candle right here. If we can do that, we know that more than likely they're going to be closing above the T-line. We can start buying because, remember, a candlestick buy signal in the oversold condition and a close above the T-line makes for not only an uptrend, but usually a very strong uptrend. If we see it close above the T-line and they gap it up the next day, so many times I hear people say, oh, I don't want to buy a gap. I don't want to buy a stock that's up 3, 5, 10, 15, 20, 40, 80%. You do if it's coming off a candlestick signal or pattern. These are where you get the evidence right away in a graphic depiction that there's been a change of investor sentiment. I'm going to try to read some of the questions as we go along. Some signals are stronger and higher. Yes, Omni Trader both measures strength of the signal and profit potential. Okay. It's been a long time since seeing a trend like that. Okay. How's your system working in this market? To wait and see. Do you speak Japanese? Nope. No, I wouldn't know how to say yes or no in Japanese. There's our bullish engulfing signal. There's our close above the T-line. How long do we stay in this? There's our J-hook pattern. Couldn't close below the T-line. Now, there's one caveat to the T-line prognosis, is that the further away you move from the T-line, the higher the probability they're going to come back and test it. So if I'm in an overbought condition and I've started to move away from the T-line, and here's a whole other subject, but you can see this little green line. That's the 3T line, which becomes much more effective when you're starting to move too far away from the T-line. That if we start seeing a candlestick reversal signal, such as a harami, bearish harami, hanging man, we know that it's time to start taking profits because where are they going to move back to? Probably back to the T-line. Are they going to hold there? We don't know. We'll find that out once it gets back to the T-line. The other moving averages, as I mentioned before, act like magnets. When you move away from a major moving average, we'll come back and test it. And when we can see buy signals, we know that now we're in wave 1, wave 2, wave 3. we can see what type of signals are occurring at this point, telling us, and then notice what happened at this little resistance level. They gapped it off a doji. A doji followed by a gap up is what we call your best friend. And the reason for that is because the frequency is quite plentiful, number one, and number two, the magnitude of the move on a doji gap up is usually going to be extremely strong. All boats are going to rise in a rising tide. We're trying to find those boats that are going to rise a heck of a lot faster than everything else in the market. A doji, smack dab on the 50-day moving average, stochastics in the oversold area, and a close above the T-line. Tells us we want to start buying. There's our left-right combo. A left-right combo is a doji, which means indecision between the bulls and the bears, followed by a bullish engulfing signal, which tells you they've told you which way they're taking their decision. It's time to and then notice what they did after their signal. They gapped it up. That told you not only had they changed their investor sentiment, but they're anxious to get back into this position with great enthusiasm. Notice when they gapped it up, what they did. They broke this downtrending channel of the T-line. Where's their next target? More than likely where everybody's going to be watching to see what it does up here, and we have a kicker signal that closes back below the T-line. That told us on this day we need to stay above the 50. If they gap it down below the previous day's open, especially in an overbought condition, there's only one thing you want to do. Close it immediately, because more than likely they're going to be in a downtrend until the next buy signal. The next buy signal, as we can see right here, is what we call an inverted hammer. It's telling you where the bulls are starting to take control. The inverted hammer is one of the 12 major signals, and the reason it is because if you see an oversold condition and an inverted hammer and it opens positive the next day, now this is unofficial, this is just my observations over the last 30 years, that the probabilities of an uptrend are probably about 95% or even greater to the upside, which also makes the stop-loss process very simple. If you take my word for it, and you don't have to, you can always back test it by watching, going back through charts and find these and see what happened afterwards. But if it's 95% or greater, the other side is, where should this not trade if it opens positive and starts moving positive? It shouldn't trade back down through here. If it does, you close it out immediately. Same on the sell side. This is what we call a belt hold bearish engulfing signal. Close below the T-line. Opens lower the next day. We want to stay short until we see a candlestick buy signal and a close back up above the T-line. So dojis at the T-line are very informational. Tells you they're not coming back with any decision, and or this is what we call a T-line crunch. You see how the T-line pushes this move right up through the resistance level, the 50-day moving average. We also know the simple rule of a doji is, as we see right here on the 50-day moving average, it's going to move in the direction of how they open it after a doji, which makes this very simple. If we see it open positive, we know it's going to trade positive, which also tells us they're going to break out above the 50, and they're breaking out through this resistance level. That makes for a very high probability directional trade as well as a high probability strong trade. If one doji means indecision, a series of dojis means great indecision. So if we're in the oversold area again and we see a series of dojis and they close up above the T-line, we want to be buying. Anytime we see this doji, remember the Japanese rice traders make the analysis of human sentiment very simple. Where do most people sell? They panic sell at the bottom. Where do most people buy? They buy exuberantly at the top. That used to be me. I was always bailing out on the bad news, and I'm thinking, man, as soon as I sold out, they started buying this. What's wrong with me? Well, now I watch for those signals. And when is it time to start buying? When they had a series of dojis and a close back up above the T-line. This is not rocket science. This is just using the information that the Japanese rice traders have utilized for the past 400 years. And the family that developed candlesticks didn't become wealthy in Japan. They became legendarily wealthy. They were the powerhouse in Japan for for centuries. And I tell people, you don't have to have a lot of technical analysis background. All you have to do is be able to see to analyze candlestick signals. And I put it in the story of the old couple getting ready for bed, and she's standing there naked in front of the mirror, and she says, "Look at me. My face is wrinkly, my arms are skinny, my butt's scrawny, my legs are spindly." She turned around to her husband and said, "Is there anything you can say about my body that would make me feel good?" He goes, "Well, your eyesight's still pretty good." So as long as you can see, you can take advantage of what's happening in investor sentiment based upon the reoccurring signals and patterns. The dogeys represent indecision. If you see indecision going on, get ready for what way they're planning to tell you they're taking that trend. And usually after a long series of indecision, the decision will usually be fairly strong. Fry pan bottoms are a pattern. The signals are individual formations. The patterns are a series of or long-term type pattern. A fry pan bottom is a slow rounding bottom that you couldn't trade one way or the other until they break it out to the other side of that pattern. Now, we just went through a whole session saying you're looking for candlestick buy signals in the oversold condition. Usually, on a pattern, you're going to start breaking out when the stochastics are telling you that you're in the overbought condition. Okay, well, good. My jokes stay the same, and that's only for one reason, because candlestick signals and patterns have been the same for 400 years. Nothing changes. So what do we expect coming out of a fry pan bottom? A very strong price move. And when does it usually occur? That makes for optimal timing for getting in, that if they break this out to the beginning of that fry pan bottom, and we can recognize visually that fry pan bottom, we can expect a very big trade to the other side. We also know that if you're coming out of a fry pan bottom, usually you start trying to see some very strong breakouts, like a doji or a harami gap up. And then what do we expect after a fry pan bottom? A very strong price move. That takes us into our next pattern, which is the J-hook pattern, which we know that after a strong price move, if we start seeing a J-hook pattern, which is where they pull it back and then curl it back up, and notice again how this one got started with our doji sandwich. And there's a simple expectation of a doji sandwich, that there's going to be more upside. So if we can expect there's going to be more upside from the doji sandwich, and we can see it's doing a J-hook pattern after a strong price move, we can pretty well anticipate that this move right here will probably be the same magnitude as this move right here. I'm buying based upon the patterns and staying above the T-line. I'm taking profits when it's time to take profits, and I'm getting back in. Look what happened right at the breakout level. A doji sandwich. How long do we stay in this? Until we see a sell signal too far away from the T-line. We take our profits. Now that looks like it's setting up again for another doji or a J-hook pattern. We could always buy back in. This is one of the big elements of candlesticks, is because the signals tell you with a high probability what's happening in human nature, and human nature works the same way time after time. It used to be that I would never want to come out of the trade because this might be the trade that makes this might be the Dell of my lifetime where I can make a fortune. And I don't want to take profits because, boy, would I look stupid if I sold here and it turned around and took off without me. Well, now I know the probability to say it's time to come out, and I get back in where I used to didn't get back in. I said, oh, they fooled me out. I'm not going to get back in. They're going to fool me again. Now I know when it's time to take profits and when it's time to buy back in. It takes my decision or my emotions out of my decision making. Fry pan bottoms have expectations. That's a strong price move. J-hook patterns have an expectation. That's a prerequisite of a strong price move, and then you can start buying again. So even if you miss this move, you can pretty well gauge how far this move is going to be based upon what wave one was. When do we sell? What do we expect coming out of a fry pan bottom? Exuberant buying. There's very simple rules of when to take profits, especially when, notice how far away not only did it move from the T-line, but also from the 3T line up here. Where should it not trade if we're in an uptrend? It shouldn't come back in an overbought condition back below the previous day's open. That's where you set your stop and take your profits. Same scenario on a dumpling top, a slow rounding curve with the expectation we're going to be in a strong downtrend. Dumpling top, there, notice how we get sell signals here, started breaking down. Notice what's happening here. This is, again, a dumpling top and or your bearish J-hook pattern. If it broke, and notice what we had right here. This is why your entry strategies can be very simple. Notice we have a down day and a doji right here on the support level. What do we know about a doji? It's going to move in the direction of how they open it after a doji. So if they opened it lower, that told me there was going to be another down day like this, which also told me they weren't supporting at this level anymore. I can be going short. On the other hand, if I see it move positive, it's telling me this is a double bottom here. I'll start buying once it comes back up through the T-line. Whoops, that was it. Slow curve is a derivative of the fry pan bottom. Fry pan bottom usually is a big, long, rounding curved bottom, usually at the bottom of the trends. Well, in an uptrend, if you see this slow curve, and notice how the slow curve acted. Look at all the dojis. This means indecision on the pullback, which means they aren't real aggressive as far as selling. And then there again, there's our doji sandwich. They gapped it up, another doji sandwich. We're buying right here because one of two things are going to happen. If they break it out, you've got the potential of a very strong price move. Where can we get these charts? As far as these charts, this is all being recorded, Manfred. And I guess that's the question. So I'm buying right here or right here because I know it broke out, because I know my risk-reward factor is that if it came back and closed below the T-line, it fizzled. I'm back out of the trade. If it moves, I've got a very strong price move in progress. J-hook confirmation is seeing that pullback and knowing that it broke out through here. A lot of people will ask, well, where do you buy the J-hook? If you're more aggressive, you buy right here on the buy signal, knowing that you're heading up. But if it failed right here, then you've got a double top. You come right back out, hopefully with a break even or a small profit. If it goes through, more than likely, you're now in the J-hook pattern that this wave right here is going to be the same as this wave right here. This is what we call the classic. That's a fry pan bottom, strong price move, J-hook pattern, another strong price move. How do you know if it's a J-hook until after it's formed? Well, that's what we're analyzing right here. We know the prerequisite of a fry pan bottom is a strong price move. We also can see, based upon the nature of these signals, remember, dojis represent indecision. So if they're pulling back and they're doing doji type days or little trading days, inverted hammers, things that show indecision, we know they're not pulling back very hard. We're getting ready for the next move. And there's that left-right combo that tells us if it opens positive, they're confirming this signal, staying above the T-line, and they're breaking out through here. We want to be buying. And how long do we hold on to it? Until we see a candlestick sell signal and a close back below the T-line. Let's see, we did that one. So the candlestick signals and patterns are quantified. I've got a video out there that shows some of the signals and patterns. Number one is your best friend. Your best friend is seeing a doji in the oversold condition. And remember what a doji represents. Indecision between the bulls and the bears. And if they gap it up the next day, what's that telling you? That after their indecision, they're very anxious to get back into this position. And we call it your best friend because the probabilities of being in an uptrend are very strong, and the magnitude of the move is usually very strong. This gap up told you there was a lot of pressure to the upside, especially if you're in the oversold area. That makes for a very high probability, high profit trade setup. It doesn't have to be in the top of a trend. Here's our J-hook pattern setting up with a doji followed by a gap up above the T-line. What's this represent? A very strong reversal. And if it's a very strong reversal, if it moves up from here, what do we have? We have a J-hook pattern in progress. So we can use it as pattern confirmation, again, with that doji gap up telling us we're getting ready for a J-hook pattern. So we know what to expect coming from from the best friend signal. Strong up move. We also know what to expect if it breaks out through here. A J-hook pattern where this magnitude move right here is the same as this right here. We also can project what our targets are based upon the signals and where our stochastics. So this is what my late friend Dave Elliott called the blue ice failure. And the blue ice failure was they fell through the ice. They came all the way down to the bottom of the pond. They came back up trying to find the hole they fell through. They couldn't find it. They drowned. They went right back down to the bottom of the pond again. That's your target. Now, as a side note, I used to do a lot of live training with David around the nation. So I always helped his people listening to his presentation by adding to the story of how do you catch a polar bear. Well, you cut a big hole in the ice, and then you take a can of peas, and you spread the can of peas around the edge of the hole, and when the polar bear comes down to take a pea, you kick him in the ice hole. It wasn't really a technical story, but helped him remember the blue ice failure. Again, if we see a strong price move, notice what we have right here. Dogeys, inverted hammer, bullish confirmation. The expectation is that this move right here will be the same as this move right here. A very simple wave 1, wave 2, wave 3 type pattern. I can buy based upon the appropriate time to be buying. I know how long to stay in the trend. I know when to get out when I'm away from the T-line. And again, Japanese race traders say, where do most people sell? They sell, or where do most people buy? They buy exuberantly at the top. So if I see a gap up doji in the overbought condition, I know the simple rule of the doji. It's going to move in the direction of how they open it the next day, which is lower. Where's that taking me to? Probably back to the T-line. So I take my profits. When can I get back in? When I see that inverted hammer and they start looking like they're going to close back up above the T-line, I can always buy back. Taking profits at the optimal time. Remember, there's candlestick truisms. The further away you move from the T-line, the higher the probability it's going to come back and retest it. So if I see a pattern and I start seeing sell signals that far away from the T-line, as soon as it confirms my reversal signal, I'm closing it out. I can always buy back here if there's a J-hook, but I'm going to wait for the J-hook. In this case, it hasn't happened. These are high profit trades. This is that slow curve. Indecisive back on the T-line, and when did it break out? Coming out of the slow curve, popping to the upside. If I bought options right in here, because remember, what do we have on an inverted hammer? If it moves positive, more than likely it's going to move positive. If it moves positive from here, it's telling me the slow curve is working. And when do I take profits? When I see the first bearish Harami, I can start taking profits. We made very good money on this one not too long ago. Notice the fry pan bottom. We were buying right here just as it was breaking out. A couple weeks later, I think we were buying it, about $12.30. It came up here. But notice what's happened right here. We're already starting to move away from the T-line. And we're above the 3 T-line. And it started selling off right here. When was it time to take profits? Well, once I start moving away from my daily chart, which I usually do, I'm trading usually a swing trade, so I'm using the daily charts. But if I've got something that's way far away from the T-line, all I do is flip to my 10-minute chart. And notice what happened on the 10-minute chart. It moved up that morning and started pulling back. We closed out right here as it was coming back down through the T-line. Why? Because we were already on the daily chart way in the overbought condition. It came back, and then notice what it did. It came right back up above the T-line. We were buying back in. Why the heck would you be buying on a well overbought condition, or stock in overbought condition? Because the 10-minute chart says they weren't selling, and what do we expect coming out of a fry pan bottom? A very strong price move. So we just used the 10-minute chart. The next day they opened it lower. We closed out here. We had another day of profits in that trade. Where's a good place to get education about options, calls and puts? Oh, doesn't Mark teach you on options? There's plenty of places, Michael. yeah, I thought Mark Trader taught some good option strategies. We also have an option trading room. We've got the 3T is the the 3T is the 3 exponential moving average, and we use that to refine our training. Again, the further away you move from the T line, the 3T line comes into effect. It has 2 functions. The further away you are from the T line, the higher the probability it's going to come back and test it, the 3T and the T line. And secondly, if the 3T can't close below the T line, you know you're still in an uptrend. When it comes down through the T line, it tells you not only is your signal telling you to be out, but also that you're not holding on at the T line. So every time I see a stock or a price move away from the T line, remember we have a very simple rule. To stay in this one, usually we would take off half our position here, because if it moved positive from here, we're in a high risk situation, but we're still making money with half our position, which is my biggest problem. Is our biggest bugaboo in most of our investing is our own emotions. And when it's up here like this, boy, what are we thinking? It's going to go through the roof. Well, usually the probabilities are, if I sell half here and sold the other half here, I can sleep at night knowing that I got about this much as far as profits. Or if I see it gap up, there's a very simple rule that we use for taking profits. If we're back up in the overbought condition and they gap it up and start trading positive, very simple. You put your stop at that open, because logic says if it comes back down through there, especially in an overbought condition, it's going to create some sort of candlestick sell signal. On the other hand, if it opens and immediately starts selling off, we put our stop at the close, because if it comes back down through there, the close of the previous day, it's going to create some sort of candlestick sell signal. Anytime I see that gap up in the overbought condition, I'm taking profits, especially if it's doing a candlestick signal. Now, this one opened here and closed here at the end of the day. That's obviously a shooting star doji. I'm closing out half the position. If it moves up from there, at least I'm in half the position of high risk. If it opens here, I'm closing it out. So I got most of that profit. And the candlestick signals also tell you when to be out of the position. Here's that inverted hammer, opens positive the next day. Where should it not trade at all? Back below this level. If it did, what's that telling you? Number one, it's telling you the T-line's still acting as resistance and the buyers aren't there. If you were short and you covered your short and went long, you're back to shorting it with it telling you now we're in a bearish J-hook pattern. A lot of people say, do you buy going into earnings? We do, because that's what the signals are telling us. Remember, it's the cumulative knowledge of everybody buying and selling, and if somebody is announcing their earnings that afternoon and people are buying going into the earnings, like in Amazon, at the end of the day, 10 minutes before the close, we were buying the calls for 51 cents. A few days later, we were selling out at 3.80. What was our risk reward? We knew that they were buying going into the close, and notice the T-line crunch. They hadn't been able to close it below the T-line. Do we always get big moves like this? Definitely not, but using the candlestick analysis, at least we're put into positions where the probabilities are greatly in our favor that we know where the bulls and the bear pressure is going to be. On the other hand, GMCR, a while back, on that day going into closing, they were selling off. We were buying puts right here. They announced their earnings and it opened up down here someplace. Netflix, same scenario. This was going into the close, or going into the close when they were announcing their earnings afterwards. We were buying calls right here, because our risk reward factor is if it traded back below the next day below the T-line, we're back out. We got this. How long do we hang on to this? This is what we call 45 degree. There's our pattern to buy, and there's no sell signal, and it closed below the T-line until up here just last week or a couple weeks ago. So when to take profits is very simple. If we see a price starting to move way far away from the T-line, Is this time to take profits? Well, if this did a sell signal, we may have given up a lot of profits. Again, that's where you flip to your 10-minute chart. 10-minute chart. Hang on to it. Now, notice what happened on the 10-minute chart. There's that bearish doji sandwich and it closed below the T-line. And notice that your 3T line is coming down through the T-line. We're coming out here. Why? Because on our daily chart, we're way up here. We're taking profits on the 10-minute chart because we already know the daily is way overbought. So we're taking our profits up here versus giving a lot of it back before the end of the day. All time frames. It works on all time frames. Oh, and I goofed up. We shorted STX a while back because notice the shooting star, then the gap down. Remember, a candlestick sell signal and a gap down. That tells you they want to be out of this with great enthusiasm. I was trading coffee last week. Buying here, there's that little morning star type signal, your bullish harami. Taking profits up here. It started pulling back, and we're buying back in here because that told us they weren't staying below the T-line, starting back up. ADX, the reason I have note here, this was still moving positive after the buy signals when the market was selling off pretty hard. And in our chat room, we've got an option trading chat room. We have one chat room that has about 250, 270 people in it with all levels of experience on candlesticks. It's a good place when you're learning candlesticks to be able to ask questions and or see the analysis of other people's charts of why they're buying or selling. But our chat room, they started buying the puts because there was kind of a little hanging man, closed below the T-line, bond prices went down. And so I tell people, do we always get into positions like this? Definitely not. But if we're buying based upon this signal right here, which was your doji sandwich, right smack dab at the breakout level of fry pan bottom, convergence analysis tells us we've got all the elements of being in the right place at the right time. We're expecting it to come up here, same magnitude as this day. You're at least putting yourself in positions where big profits, you're going to be in situations where the profits are going to be fairly big. What fractal periods do you use analyzing candles top-down analysis? I usually, if I'm swing trading, I'm using the daily charts, and then I'm usually day trading, but I'm usually day trading things like the crude oil, soybeans. I trade commodities during the middle part of the day. We do have scans. Their scans are available all over the place now. We've just done scans for Thinkorswim, TradeStation. They're on Metastock. Our formulas are on Warden Brothers. I think they're also being put in place for NinjaTrader. I think the formulas are right now being established for E-Trade. So they're all over the place. All you have to do is on whatever trading platform you're using, just go and search to see if the candlestick formulas are available. This is what we're expecting coming out of this slow curve, these strong price moves. This is where you make your big profits, knowing what patterns or the expectations of each pattern, and knowing what to do if you happen to miss wave one coming out of this fry pan bottom. We know what to look for on the J-hook pattern for the next price move. This also works extremely well when you're analyzing the trend. Very simply stated, if we know that the Dow's in an uptrend, more than likely you want to be looking for bullish charts. If the Dow's in a downtrend, we want to be looking for bearish charts. Notice what happened right here. We had a bullish day, sell it off. Then we had the bullish harami, and where did it occur? Right smack dab on the 200-day moving average. The next day they closed above the T-line. That already gave us the indication we're in an uptrend. The next day, very simple. They had a doji right smack dab on the 50. And what do we know about that setup? That if they open positive, this day right here is probably going to be the same day as magnitude as this day right here. And if that's the case, what's that telling us about this little downtrending channel? That they're breaking that we're going to be in an uptrend. There's our sell signal, that bearish harami closed below the T-line. Now, what we are expecting, I can't make this chart, but this has been in a channel. Up here was the top of the channel, down here was the bottom of the channel, failed at the top of the channel. So the expectation was, here's the bottom of the channel. Except, what do we see right here? A morning star signal and a close above the T-line. And today, with the big reversal from the Fed announcement, this just continued the bullish sentiment. So what's this tell us about the trend? Well, we can kind of extrapolate that if they were coming down, coming up, should be coming down here. If they only pulled back here, now what type of pattern do we have setting up? The J-hook pattern, which tells us if this move right here is the same magnitude as this move right here, that more than likely this upper trend channel is going to be breached and we should be in a fairly strong uptrend. These are the ones somebody asked earlier, do they work on today's charts? We were buying the calls just a couple of days ago on ESPR because of this fry pan bottom. I think we are buying the 75s at about $4.60. Today, I think they're about $24 or $26. We also recommended Jiva a couple of days ago. Notice what it did. Came out of this fry pan bottom, told us the 50 wasn't going to act as resistance. Those calls are working very well. So this is not rocket science. As I said, this is just seeing what usually happens with investor sentiment based on patterns. We've recommended IIVI because look at this fry pan bottom and notice what it's done. It's broken out through this level. Good possibility that you can have a very strong price move. I'm trading crude oil. I've been short crude oil all the way down until we saw this candlestick reversal signal, which is a big morning star signal, and a close above the T-line. Where did it fail? Up here at the 50. Now today, this was today's trading. I reversed the position because we were in the oversold area and the 10-minute charts were starting to show that the buying was coming in. I reversed the position, and this was a little bit after hours, just right before we started. So that tells me there's probably more upside. The 10-minute chart, this is where I reversed my position. When they broke out through this resistance level on a slow curve, made very good profits, took my profits right here. And notice what's setting up right now. This was on the 10-minute chart about 10 minutes before our session. It looks like the 10-minute chart is setting up another fry pan bottom. I'll start looking to buy if it starts coming back up. So again, this is just taking human nature and being able to buy at the appropriate times. I try to put out 2 or 3 stock picks. Our website, as I said, we usually have in our chat room, we've got anywhere from 250, 270 people in the regular chat room. There's about another 45 to 55 in our option trading chat room. And the option trading chat room is to take the patterns and try to apply the correct trade formula to it. Not trying to teach people newfangled trading methods, but which trades or which option trades are appropriate for the patterns they're looking at. So I put out 2 or 3 picks each day, and I tell people it's not so people have picks so they can just trade. We do it in a video format, 2 minutes every night, so people can be learning why those picks are being made. And I kind of make it that if you just listen to somebody and follow what they say, you're not learning anything. I try to have this as an education process constantly, and it's kind of like I tell the story about the cop that's standing on the street corner, and he sees this car weaving down the street, blows his whistle, pulls the guy over, the drunk sitting there, and he looks in the back seat, and there's a penguin sitting there. And he says to the drunk, "What the heck do you got a penguin in your back seat for?" And he goes, "Oh, I found him out on the street, and I don't know what to do with him." And the cop said, "Well, take him to the zoo." The drunk said, "Oh, good idea. I didn't think of that." Well, the next day, the cop's standing on the corner, and here comes this car weaving down the street again, blows his whistle, pulls the guy over, same drunk, walks up to his window, and the penguin's sitting in the back seat. He goes, "I thought I told you to take the penguin to the zoo." Drunk said, "I did. He liked it so much today we're going to a baseball game." So if you don't understand why you're doing some of these, you're not learning anything. We put out the stock picks about 2 to 3 each night so that you have a learning process of why that chart is working. So remember, candlestick signals are the graphic depiction of the most consistent indicator in the world, and that's human emotions. So with that, oh no, with that, I think, oh, hold on for a second. I thought, oh, obviously, Pat wanted to do a special. Let me see if, yeah, Pat has put out a special. I think we've got some videos on the, here it is, if I can grab it. Mark, are you there?
Yeah, here.
I don't know whether I can stick this in the, do you have the link?
Yeah, the link, here, let me make myself presenter.
Let me see.
And here you go. Here is how you can check out Steve's special offer. Steve, you want to walk through it?
Yeah, I'm trying to, let's see if I can get the link to you where you can put it into the chat room.
Oh, I just did. Oh,
you did? Okay.
Uh-huh.
All right. Anyways, I think it's about $177 worth of videos of how to use the signals, is what we call the unfair advantage, because we can see well below or well before everybody else when the buying and selling is coming in. And that's $177 for 17 buckaroos, 3 Starbucks coffees. And so a lot of people ask, well, why the heck are you selling, if this is good information, selling it so cheap? Because through the years, my rhetorical question has always been, when I started using candlesticks, I would ask people, I'd say, why the heck isn't everybody using candlestick signals? They make so much sense. And the answers were, oh, there's too many of them to learn and they don't always work. And I always came back to a simple analysis that if they didn't work, we wouldn't be looking at them 400 years later. There's one simple rule on Wall Street. If something doesn't work, it disappears very quickly. So the other element was, yes, there were 50 or 60 signals, but you didn't need to learn all of them. So the 12 major signals are the ones that through the years I've discovered that if you just learn those 12 major signals, you've got 2 benefits. One, the visual recognition of when investor sentiment is changing, and 2, the Japanese rice traders describe what the change was in investor sentiment. So that combination alone, once you learn that, you've got kind of the same insights into candlestick analysis or into trend analysis as somebody that's been investing for 40, 50 years. Let's see. I don't know that maybe I don't know whether this one includes the 30-day trial. That's something you will have to ask Abraham at candlestickforum.com. And stock recommendations, yes. And that 30-day trial, you get the you're just like a full-fledged member. And then at the end of that trial period, you're asked whether you want to continue or stop. Can you move the offer page further down? Oh, let's see. I think, let's see, did you put the link in? Let me see if I can do this. I always have.
Yes, it is, and here I'll drop it in again, just so that everybody has it. So here you go, here's the room, one more time. If you look in the chat.
Oh, yeah, there it is, way over to the right.
All right. And so there you
okay.
have it. I'll put it one more time. You can see it in both the questions, and I put it in the chat. So you guys are welcome to sign up and take advantage of Mr. Bigelow's great offer.
Oh, yeah, so again, the reason we're putting it out at $17 is that most people keep thinking, oh, this is too difficult. It isn't. It's once you visually start recognizing the signals and the patterns, it becomes very simple. It basically puts you in the right position at the right time. And let's see, I don't know whether I can get back to where I wanted to be, way down here at the end. Oh, this is what I wanted to kind of illustrate, if I can get...
You want the presenter back, Steve?
Oh, yes, if I could, please.
All right, let me make you presenter.
Okay, are we seeing my screens again?
Yes.
Okay, here's one thing I wanted to illustrate, because the patterns are usually built-in investor sentiment. Let me see if this... You can see what the what's been happening in the markets, or the Dow here for the last few weeks. But you can see what's happening in these fry pan bottoms. They are, again, these are the cumulative knowledge of everybody buying and selling. You can see they were still buying even if the market was selling off until they got to the breakout. Same thing with Jiva. It was starting to move up even though the market itself was backing off. Is this webinar recorded? Yes, it is. Will the offer be emailed?
Yes, it will.
Yeah, I think everybody's going to be sent out a link on this.
Yeah, but I think it's limited to a limited number of people. So, you know, I would say take advantage. $17.
Yeah, for $17. Yeah, if you find it you don't like it, I'll buy you 3 cups of Starbucks coffee. What we try to do is just make sure everybody gets way more information than they expect, and the reason for that is we're fully convinced that once you start analyzing or utilizing the information that's built into candlesticks, no matter whether you've got a good, successful trading program right now, overlaying candlesticks on top of it will make it even that much more clear and more concise as far as looking at price movements. All right, any more questions? If not, thank you, everybody. Thank you, Mark, for the invite tonight.
Yeah, thanks for coming, and I hope everybody has a great night. I will have this emailed out tomorrow with a link to this special offer. I hope everybody has a great evening.
All right, thank you. Everybody have a good evening. Hopefully see you in the chat rooms.